In 2019, a single company was crowned the most valuable startup in America, worth a staggering $47 billion. Just a few years later, that exact same company filed for Chapter 11 bankruptcy, leaving behind a trail of empty offices and erased fortunes. Most people blame the collapse on the eccentric behavior of its co-founder, Adam Neumann. But the truth is much darker. WeWork didn't just fail because of bad leadership. It collapsed because of a fatal business model illusion. A trap that thousands of small businesses and solopreneurs fall into every single day without realizing it. They mismatched their numbers. They signed up for massive, fixed long-term liabilities, while relying on fragile, unpredictable short-term revenue. In this video, we are unpacking the brutal mechanics of the WeWork disaster, to show you the ultimate cash flow warning rules you must follow to ensure your solo business stays unshakable, liquid, and permanently profitable. To understand how WeWork fooled the world's smartest investors, you have to look past the free beer, the neon signs, and the beautiful office designs. You have to look at the leases. Stripped of its marketing, WeWork was just a middleman. They went to commercial landlords and signed massive commercial leases, locking themselves into 15 to 20-year fixed rental agreements. This meant no matter what happened to the economy, WeWork was contractually obligated to pay billions of dollars in rent every single month, for decades. They took these giant properties, chopped them up into tiny workspaces, and rented them out to freelancers, startups, and remote teams. But there was a catch. The people renting from WeWork didn't sign 15-year contracts. They signed up for month-to-month memberships. This is called a structural maturity mismatch. WeWork had legally binding long-term expenses, but completely volatile, short-term income. If a recession hit and members canceled their memberships, WeWork's revenue would instantly vanish, but their billions in rent obligations remained unchanged. To hide this fatal flaw from Wall Street, the company invented its own accounting terminology. Instead of reporting real losses using standard accounting metrics, they reported what they called community-adjusted EBITDA. It was a manufactured illusion that ignored real-world expenses like rent and building maintenance to make a massive money-losing operation look highly profitable on paper. But you can only outrun real numbers for so long. When the market finally looked at the true balance sheet, the illusion shattered, wiping out $47 billion of perceived value almost overnight. So, what does a $47 billion corporate collapse have to do with you running a solo business from your desk? Everything. Because the underlying physics of cash flow are exactly the same. To build an unshakable, highly profitable solopreneur business, you must do the exact opposite of WeWork. You must build an inverted cost model, variable liabilities, and fixed revenue. Let's start with rule number 1, keep your overhead variable. When most people start a side hustle or small agency, they immediately commit to fixed monthly bills. They rent an office space, sign up for expensive software suites, or pay for premium retainers. This is the trap. You are locking yourself into long-term expenses before you even prove your short-term income. If you have a slow month or a client leaves, those fixed bills will slowly choke your business to death. Instead, a smart solopreneur uses a pay-as-you-grow stack. You use free versions of video editors like CapCut, free cloud tools like Notion, and pay-per-use processing platforms like Stripe or Wise. If your business makes $0 this month, your software overhead is practically zero. Your business can safely breathe during market dry spells. Rule number 2, invert your revenue model. WeWork relied on highly volatile, month-to-month transactions. As a solo business, your primary goal is to turn transactions into recurring, predictable assets. If you run an agency, you don't sell one-off projects, you sell monthly recurring retainers or productized service subscriptions. If you are a content creator, you focus on building a recurring paid community or a subscription newsletter. When you pair ultra-low, variable operating costs with predictable, repeating revenue streams, you create the ultimate financial fortress. You become completely immune to the structural mismatch that took down WeWork. To see this working in the real world, look at how modern automated platforms allow a single individual to handle complex cross-border operations. Historically, expanding a business globally meant renting physical offices abroad, hiring international accounting departments, and taking on massive fixed overhead, just like WeWork did. Today, a solopreneur can use a digital fintech stack to handle multi-currency payments, global invoicing, and cross-border cash flow automatically, with zero upfront fixed costs. By keeping their infrastructure entirely variable, these modern microbusinesses can scale up instantly during high-revenue months, and scale down to practically zero costs when the market slows down. They don't need a $47 billion valuation to achieve global reach. They just need a lean, unshakable blueprint. WeWork tried to trick the laws of economics with corporate buzzwords, and it cost them everything. As a solopreneur, your ultimate superpower isn't your scale, it's your flexibility. If you want to keep optimizing your financial framework and learn how to position your solo business for maximum profit margins, check out our breakdown of Apple's ecosystem strategy right here. Let's build your fortress step by step. See you in the next video.